In recent days, President Donald Trump has drawn significant attention by imposing new tariffs on multiple countries, including key allies like Canada and Mexico, as well as rivals such as China. These measures are part of his America First trade policy, which aims to reduce trade deficits and counter what the administration sees as unfair trade practices. As part of this approach, the administration has proposed universal tariffs on U.S. imports, with Treasury Secretary Scott Bessent outlining a phased implementation starting at 2.5%. In addition to broad tariffs, some countries are being targeted with specific tariffs due to various disputes, including trade imbalances, immigration policies, and geopolitical conflicts. These tariff proposals have sparked strong backlash from the affected nations. Canadian officials, for example, have expressed firm opposition, with Prime Minister Justin Trudeau warning that Trump's tariffs will make everyday life more expensive for Americans. Ontario Premier Doug Ford has even threatened to cut electricity exports to the U.S. in retaliation. Meanwhile, Mexico's President Claudia Sheinbaum has criticized the tariffs, arguing that they won't solve the U.S.'s immigration issues. These reactions highlight the risk of growing trade tensions and potential countermeasures that could disrupt established economic relationships. While these trade disputes have dominated headlines, another major executive action has gone largely unnoticed. On January 23, 2025, President Trump signed an executive order titled Strengthening American Leadership in Digital Financial Technology. This order represents a major shift in U.S. policy by focusing on supporting private sector innovation in digital finance while blocking the development of a central bank digital currency, CBDC. The order prohibits federal agencies from creating or promoting a digital dollar, effectively shutting down any plans for a government-backed digital currency. Instead, the administration is prioritizing cryptocurrency and blockchain development in the private sector. This decision has huge implications for the future of digital finance in the U.S. By opting out of CBDC development, the U.S. may be giving an advantage to other nations, such as China and members of the European Union, which are actively developing their own digital currencies. Some experts warn that this could weaken the U.S. dollar's dominance in global trade and finance as digital currencies gain traction worldwide. Even before taking office, Trump had already warned BRICS nations, a group of emerging economies including Brazil, Russia, India, China, and South Africa, that he would impose 100% tariffs on their exports if they move forward with creating a new currency to challenge the U.S. dollar. He stated, "As a BRICS nation, they'll face a 100% tariff if they even think about doing what they planned. That will stop them immediately." Trump insisted that this was not just a warning, but a firm policy stance. He contrasted his approach with that of President Joe Biden, claiming, "Biden says they have us over a barrel. I say no, we have them over a barrel, and they won't be able to do this." However, this ban on CBDCs may actually benefit the global south more than it helps the U.S. dollar. Chinese officials and economists have been closely analyzing Trump's executive order, seeing it as an opportunity to strengthen their own digital currency efforts. Zhu Guangyao, China's former vice minister of finance, emphasized that digital currencies are essential for the future economy. He noted that cryptocurrencies and blockchain technology play a crucial role in developing the digital economy, and he encouraged China to monitor global trends closely. Similarly, Hong Yiping, a former advisor to China's central bank, PBOC, has stressed the importance of digital currency development. He warned that a rigid ban on cryptocurrencies may not be sustainable in the long run, and suggested that China should consider how its policies might evolve over time. Meanwhile, Josh Lipsky, director of the Atlantic Council's global CBDC tracker, has highlighted the international impact of Trump's decision. He stated that the most significant effect of the executive order is the message it sends to the rest of the world. He explained, "This move tells Europe they now have the playing field to themselves to set privacy and cybersecurity standards with the digital euro." He also noted that China could use this opportunity to position itself as a leader in digital currency technology, potentially influencing other nations to follow its lead. Not everyone agrees with the administration's decision. Vincent Arnold, a researcher at Yale's Financial Stability Program, has criticized the CBDC ban, calling it short-sighted. He argues that the U.S. should develop a cross-border wholesale CBDC, or an offshore digital dollar, to maintain the U.S. dollar's international standing. Arnold insists that while stablecoins have advantages, they cannot fully replace government-backed central bank money. He believes that a U.S. digital currency would provide a more secure and efficient way to handle global financial transactions, ensuring that America remains a leader in financial innovation. As the world moves toward a new era of digital finance, the absence of a U.S. digital dollar could have major consequences for America's role in global trade and economics. Whether Trump's decision strengthens U.S. financial independence or allows other countries to gain an edge remains to be seen. The European Central Bank, ECB, has interpreted the U.S. ban on central bank digital currencies, CBDCs, as an opportunity to accelerate its own digital euro project. ECB board member Piero Cipollone pointed out that the ban could give U.S. dollar-backed stablecoins a competitive edge, attracting more users and potentially weakening European banks. He emphasized that launching a digital euro is crucial for ensuring the continued relevance of European financial institutions, particularly as global adoption of digital currencies continues to grow. While some in the U.S. view the ban as a protective measure, others warned that it could backfire by speeding up international efforts to move away from the U.S. dollar. Critics argue that by refusing to innovate in the CBDC space, the U.S. risks falling behind in setting global standards for digital currencies. Over time, this could erode the dollar's dominance in global trade and finance, allowing other countries to take the lead in shaping the future of digital transactions. This development has far-reaching consequences, and in this discussion, we take a closer look at its potential impact on the U.S. dollar and economy. Since the decision to ban CBDCs could significantly affect the global financial landscape, we examine what this could mean for America's role in the world economy. Additionally, we explore other executive orders issued by President Trump that have already drawn criticism and may further destabilize key economic sectors. To understand this situation better, it's important to look at what CBDCs actually are. Central bank digital currencies, CBDCs, are government-backed digital versions of a country's national currency, issued and controlled by its central bank. Unlike decentralized cryptocurrencies such as Bitcoin or Ethereum, which operate independently, CBDCs are directly tied to the issuing country's financial system. This centralized structure ensures stability, reduces volatility, and provides strong government oversight. The main purpose of CBDCs is to increase financial inclusion, modernize payment systems, and create a more secure and efficient digital economy. These digital currencies are stored in digital wallets and function as official legal tender, making them a seamless addition to existing financial networks. Security is also a top priority, with robust anti-fraud protections and cybersecurity measures in place to prevent financial crimes. While the U.S. has halted development of a CBDC, China has taken the opposite approach, moving aggressively into the digital currency space. The People's Bank of China, PBOC, officially launched the digital yuan, ECNY, in April 2021, following extensive pilot programs in major cities. By January 2025, the digital yuan had been widely adopted and fully integrated into China's financial system, demonstrating the country's commitment to digital financial innovation. The scale of the digital yuan's adoption is staggering. As of 2025, more than 1 billion Chinese citizens, roughly 70% of the country's population, actively use the ECNY for daily transactions. Every day, approximately 500 million digital yuan transactions take place, with monthly transaction values exceeding 50 trillion yuan, around 7.2 trillion USD. The success of the digital yuan is largely due to its integration with major payment platforms like Alipay and WeChat Pay, which are already widely used across China. By embedding the ECNY into these existing networks, China has made it easier for consumers and businesses to adopt the currency effortlessly. To ensure security and efficiency, China's digital yuan operates on a two-tier system. The People's Bank of China issues the currency to commercial banks, which then distribute it to users through bank accounts and digital wallets. This approach allows the central bank to maintain full control over money supply and circulation, while leveraging the existing banking infrastructure to handle distribution and transactions efficiently. China has also built several advanced features into the digital yuan to enhance its functionality. One of the most notable is offline transaction capability, which allows users to make payments via Bluetooth or NFC technology, even when they are not connected to the internet. Another key innovation is programmable money, which enables smart contracts and conditional payments, making it possible for businesses to automate transactions based on predefined rules. In addition to these features, China has implemented strict security protocols to ensure user privacy while still allowing regulatory oversight to prevent financial crimes. Beyond its domestic use, China is actively working to expand the digital yuan's role in international trade. By promoting ECNY in cross-border transactions, China hopes to increase global adoption of its currency while reducing reliance on the US dollar. A key strategy has been establishing currency swap agreements, which allow countries to trade directly in yuan without converting to US dollars first. By 2024, China had signed such agreements with 15 countries, including Argentina, Brazil, Canada, and the UK. These agreements facilitate direct trade using digital yuan, reducing the need for USD-based transactions and strengthening China's financial independence. China has also taken steps to establish offshore yuan trading hubs in Hong Kong, Singapore, and London, further reinforcing its global influence. Hong Kong alone now handles nearly 50% of all offshore yuan deposits, making it the largest center for digital yuan transactions outside of mainland China. These moves are designed to increase China's financial sovereignty while positioning the digital yuan as a serious competitor to the US dollar in international markets. With the US stepping away from CBDC development, China and the European Union are now setting the standards for global digital finance. Although the US dollar remains the world's dominant reserve currency, the rise of digital alternatives, especially the digital yuan, could gradually challenge its status. If more countries adopt China's digital payment system, the global financial landscape could shift, reducing America's economic influence. At the same time, central banks around the world are diversifying their foreign exchange reserves, shifting away from USD dependence by including more ECNY holdings. China's currency swap agreements allow other nations to hold yuan in reserves, facilitating trade settlements in yuan instead of US dollars. This diversification strategy helps promote financial stability while also reducing vulnerability to USD-centric economic fluctuations. If this trend continues, it could weaken the global power of the US dollar, diminishing America's ability to use economic influence as a geopolitical tool. The USD's dominant role has long provided the United States with significant leverage in global finance and diplomacy. However, the rise of the digital yuan is beginning to undermine that influence. As more countries adopt ECNY for international trade, they gain the ability to circumvent US sanctions and financial restrictions. For instance, China's currency swap agreements allow countries to trade outside the USD-based financial system, making it easier for sanctioned nations to continue global transactions without relying on US banks. This shift reduces the effectiveness of US economic policies as a tool for foreign policy, potentially limiting the government's ability to pressure other nations through financial means. Amid these global financial shifts, the US government has also introduced new trade policies that could further impact international relations. President Donald Trump announced a 25% tariff on all imports from Mexico and Canada, set to take effect on February 1, 2025. This decision is part of his administration's America First trade policy, which aims to reduce trade imbalances and boost domestic manufacturing. However, given the deep economic ties between the US, Canada, and Mexico, these tariffs could cause major disruptions in trade, affecting businesses and consumers on all sides. The United States has a massive trade relationship with its two neighbors, highlighting the economic interdependence within North America. In 2022, total trade in goods and services between the US, Canada, and Mexico reached approximately $1.76 trillion. Trade with Canada alone accounted for about $908.9 billion, with $427.5 billion in US exports and $481.2 billion in Canadian imports. Similarly, US-Mexico trade was valued at around $855.1 billion, including $362 billion in US exports and $493.1 billion in imports. These numbers underscore just how critical Canada and Mexico are to the US economy. Implementing a 25% tariff on imports from these nations could have widespread consequences, particularly for industries that rely on seamless cross-border trade. One sector that would feel the impact most is the automotive industry, which is heavily integrated across North America. In 2024, the U.S. imported over $22 billion worth of automobiles and related parts from Canada and Mexico, demonstrating how essential cross-border trade is to vehicle production. The imposition of tariffs could drive up production costs, disrupt supply chains, and lead to higher car prices for consumers. Additionally, Canada and Mexico are key markets for U.S. exports, with Canada being the top export destination for 36 U.S. states, and Mexico serving as the largest export market for 6 states, including Texas, Arizona, New Mexico, and California. In New Mexico alone, 70% of its exports, valued at $3.5 billion, are destined for Mexico, further emphasizing the economic ties between the two nations. The agriculture sector is another area that could face significant disruptions. In 2023, Mexico's total agricultural imports from all countries amounted to $32 billion, with the United States supplying approximately 74% of those goods. If trade tensions escalate, U.S. farmers and agricultural producers could see reduced demand, leading to potential losses and higher food prices in both countries. Energy trade is another crucial factor. The United States depends on Canada and Mexico for a significant portion of its crude oil imports, making them key players in North America's energy market. In 2022, Canada accounted for 60% of U.S. crude oil imports, while Mexico supplied 10%, meaning the two nations together provided 70% of America's imported crude oil. By October 2024, U.S. crude oil imports from Canada reached approximately 4 million barrels per day, while imports from Mexico stood at about 383,000 barrels per day. This heavy reliance on Canadian and Mexican oil means that tariffs on energy imports could disrupt supply chains, potentially driving up costs for U.S. refineries and consumers. Higher tariffs on imported crude oil would likely result in rising gasoline prices, adding financial pressure on American households and businesses. The proposed 25% tariffs on imports from Canada and Mexico could introduce major challenges for the U.S. economy, forcing industries to restructure supply chains and find alternative sources for critical materials. In the short term, this could lead to increased costs for manufacturers, higher prices for consumers, and potential trade retaliation from both Canada and Mexico. In the long run, these tariffs may drive both nations to seek new trading partners, reducing their dependence on the U.S. and further weakening America's economic influence. With growing trade tensions and shifting global financial landscapes, the U.S. faces a critical moment in shaping its economic future. Whether these protectionist policies will achieve their intended goals or trigger further instability remains to be seen. The coming months will determine whether diplomatic efforts can ease tensions or whether the world is headed for a full-scale trade conflict. In addition to the previously discussed tariffs on Mexico and Canada, the Trump administration has also introduced significant tariffs targeting China and the European Union, EU. These trade measures could have major consequences for the U.S. economy. A 10% tariff on all Chinese imports, set to take effect on February 1, 2025, is part of a broader effort to address trade imbalances and concerns over China's trade practices. However, this move is expected to raise prices for American consumers, as the cost of imported goods from China will increase. This could add to inflationary pressures, making everyday items more expensive. Many U.S. businesses also rely heavily on Chinese manufacturing for essential components and finished products. These new tariffs could disrupt supply chains, increasing production costs and causing potential delays in manufacturing. China is also expected to retaliate with its own tariffs, which could harm key U.S. industries such as agriculture and manufacturing. A decrease in demand for American products within China could hurt U.S. farmers and exporters, leading to potential financial losses. Beyond China, the Trump administration has also threatened tariffs on the European Union, demanding that the EU increase its purchases of American oil and gas. President Trump has warned that if the EU fails to comply, it will face higher tariffs all the way. This could severely impact the European automotive industry, as the EU is a major exporter of cars to the U.S. Higher tariffs on European vehicles could raise prices for American consumers, while retaliatory tariffs from the EU could hurt U.S. exports. The possibility of new tariffs on European goods has also raised concerns about strained diplomatic relations between the U.S. and the EU. If the trade dispute escalates, it could lead to a full-scale trade war, further disrupting global markets and destabilizing the global economy. At the same time, the absence of a U.S. central bank digital currency, CBDC, is becoming a serious risk to the global dominance of the U.S. dollar. While the U.S. has rejected the idea of a digital dollar, other major economies, particularly China and the European Union, are rapidly advancing their own digital currencies. The rise of the digital yuan (ECNY) and the digital euro is creating faster, more efficient cross-border transactions, giving businesses and financial institutions alternative options beyond the traditional U.S. dollar-based system. One of the biggest risks to the U.S. dollar's dominance is the growing shift in global trade invoicing. Historically, the U.S. dollar has been the primary currency for international trade and pricing agreements. However, as CBDCs gain popularity, countries may increasingly use digital currencies for trade settlements, reducing their reliance on the U.S. dollar. This shift is further supported by alternative payment networks, allowing nations to exchange currencies directly without using USD as an intermediary. If this trend continues, the global demand for the dollar will naturally decline, further weakening its role in international trade. In addition to trade invoicing, the global adoption of CBDCs is also impacting central bank reserve holdings. Currently, central banks worldwide hold large portions of their foreign reserves in US dollars, reinforcing the dollar's status as the world's reserve currency. However, as digital currencies issued by other nations become widely used, central banks may diversify their reserves, shifting away from the US dollar in favor of digital assets. If central banks reduce their USD holdings, it could further erode the dollar's influence in the global financial system. Ultimately, the US decision to ban the development of a CBDC could be a self-inflicted mistake, accelerating the shift away from the dollar without any direct action from geopolitical rivals. While the US dollar's dominance has been a pillar of American economic power, the refusal to innovate in digital finance could allow other nations to take the lead. If the US does not adapt, it risks losing its position in global finance, making it difficult to recover from the economic shift in the years to come. That wraps up today's discussion. If you found this information insightful, don't forget to like this video and subscribe to stay updated on more important topics. Your support means a lot, and we'd love to hear your thoughts in the comments below. Thanks for watching, and we'll see you in the next one.